Yeah, big jump in the currency. There's no doubt all of that was a change driven initially by the US rates decision, then the local unemployment rate at 3.9% for November. That was higher than expected. Now, oddly, 57,000 full-time jobs were created during the month and 4,500 part-time jobs. So you might ask, why did the unemployment rate rise? Well, Marcel Tilliard is Capital Economics Head of the Asia Pacific and joins me now from Singapore. Marcel, always good to have in the program. This is the oddity of the numbers, isn't it? Even though you've got more jobs created during that month, the unemployment rate still rises because a lot more people actually wanted a job.
Yeah, that's absolutely right. I think two factors are working. As you reported earlier, you have this record net migration, so population growth is very strong. And at the same time, the participation rate, so that the share of people actually willing to work, hit a fresh record high. So the labor supply is just expanding more rapidly than firms are able to create jobs, and that's starting to push up the unemployment rate now to about a 18-month high.
So that being the case, does the Reserve Bank take that all into account? That it's really not a lack of jobs that are out there right now creating that employment rate, but simply that the population is bigger, so more people are out there looking for a job?
Well, it's a bit difficult to interpret. I agree, but I think the key factor here is that if the unemployment rate rises for whatever reason, that means that there's less slack in the labor market, and that in turn means less upward pressure on wages, and in turn less upward pressure on inflation. So all else equal, and a higher unemployment rate should convince them that at least no further rate hikes are needed. And given that the labor market is now loosening, GDP growth is very weak, and inflation will probably continue to slow, that eventually policy easing will probably be required. And we think that might be the case earlier than most expect, maybe by the middle of next year already.
By the middle of next year. The interesting part about that is you're quite right, because it's when the unemployment rate gets to what they call the neutral rate of employment. Now, whether that's 4.25, 4.5, 4.2, that's really the important part, isn't it?
Yes, I also say that the RBA has recently been quite worried about productivity growth, which has been very weak. It's worth remembering that at the turn of the year, hours worked were rising by around total hours worked across the economy were rising about 7% over the year, which was one of the strongest paces on record. And that has now slowed a lot to just around 1.5%. So that means productivity growth is now finally rebounding. And that means that firms can basically produce more output with any given input. And that in turn also suggests that price pressures are moderating, and then the surge in service inflation that we've seen over the past year will start to cool further over the next few quarters.
So you're probably a little bit of a standout now, Marcel, because many of the economists don't see the first rate cut until maybe 2025 or at least late 2024. You've got a different view, perhaps, on the way in which the Reserve Bank interprets it. Do you get some of your guidance by what the Federal Reserve said overnight about its own interest rates and the future of the economy there?
I would say so. I mean, the US has tended to lead a lot of the trends that we saw since the start of the pandemic. So we saw the initial surge in inflation happening there first. Then inflation there starting to moderate more rapidly or more earlier than elsewhere. So we think that we'll see the same thing in Australia. And we, on our forecasts, the RBA will be pretty close in terms of inflation to levels where they have started to cut interest rates by the middle of next year. And again, given how we also more pessimistic about the outlook, the general outlook for the economy than most other forecasters. So if the economy is soft, inflation is coming down, there's certainly less need to have this restrictive policy stance, which they currently have. So we think the case for rate cuts will build. And obviously, if other central banks starting to cut, that will put additional pressure on the RBA to follow.
And the real pressure is going to be seen, as Ed showed us just a short time ago, in the Australian dollar, which really has popped almost 1.5 US cents over the past day. And that's as a result of the differential between US interest rates, or the expected differential between US rates and Australian rates.
It's one factor, but I wouldn't say it's the most important factor. I mean, obviously, a stronger dollar means less imported inflation. But over the past year or so, goods inflation has been much stronger than import prices would suggest, which reflects the sheer strength of demand. So if demand is slowing, and it is now slowing, then goods inflation will slow pretty much regardless of what the Australian dollar is doing. But at the margin, a stronger Australian dollar reduces the need to keep interest rates high. That's certainly right.
And also on top of that, for the dollar, there's also a very strong iron ore price at the moment, and that always is synonymous with the currency improving.
Yes, I think the high iron ore price is also helping the currency. It's also putting more money into the government's coffer, so that the tax intake is very high. I mean, the tax intake is high for other reasons as well. We've also seen recently the largest gap between growth in disposable incomes of households and growth in wages, because the tax take has risen at a rate never seen before. And that's a key reason why household spending is now so much under pressure. And with the savings rate now close to zero, we think there's a strong chance that households will continue to spend very little, and consumption growth will continue to remain very weak.
Marcel Tillian, always good to have you in the program, and many thanks for your insight today.